It's my hope that after this video, everyone who watches it can walk away feeling like they have a level of confidence in the fact that they can actually do this. If you've watched the content on the channel, you know that I try to be real about things. I don't want to BS anyone. I don't want to blow any smoke. I want to talk about how hard this is to actually do. But I've already done that. So the tone of this video is going to be a good bit different. Now I hope to bring a message of hope and willingness to help, because I really just want people to understand what the probabilities are, what the odds are, and how hard this can be. And if you're okay with that, then let's proceed. Let's get on to the next thing. Now it's about really buckling down, having the mindset of saying, I'm not going to quit. I can do this. I'll treat every failure as an opportunity to learn, and I'm going to push forward. And so that's why I'm releasing this course today. This course is actually getting granular into the levels of what it takes to trade. Now, this is just one man's opinion, but this is how I like to trade. This is a culmination of learning over 12 years. And today I'm going to show you essentially everything that I do. Now, there's a couple of things that I want to talk about before we get into the information. This is coming from the perspective of you know nothing, but even if you've traded for years, I would still encourage you to watch the first part of this video, because one element builds on the next element, builds on the next, until I reach the final conclusion. My strategy, the full strategy, will be in the latter half of the video, but the front half of the video gives you context as to why the strategy works the way it does and why it's set up the way that it does, or sorry, set up the way that it is. The other thing I want to talk about is I have a firm belief that you always forget what you hear. You remember what you observe, but you will only ever understand what you do. I am an options trader. I have traded options for 12 years, yet I haven't talked about options a whole lot on this channel. People notice that I talk about stocks and ETFs a lot, and that's because I believe that you need to be able to trade stocks and ETFs proficiently before you ever get involved with options. Options come with a lot of inherent risk, but the returns on options are unparalleled by anything else that I've ever seen. I'm aware of the fact that a lot of people are getting involved in trading because of Forex and cryptocurrency, but I also believe that a lot of people choose those types of investment avenues because the barrier to entry is very low, and learning about options can be complex. That's why I haven't talked about them on the channel. I'm also at a place where I am stretched very, very thin, and every bit of time that I am placing into trading and trading education, especially here on YouTube, that's coming at the cost of something else in my life. But I do want to be more involved. I do want to talk about options. And so one of the things that you will see is the addition of the join button right beside the subscribe button on this channel. Now, I can hear some people saying, oh, well, here he is. I knew he was going to come after my money at some point. Well, no, I'm not going to ask you to hit the join button, but it is there for anyone who wants to take it to the next level. So I'm going to teach you how I trade today, but just like any other trading course, once you leave that course and you go to trade in real life, well, now it's real. And now the things that seem to work well on static charts in the trading course, they're harder to understand as the candles are painting themselves in real time. I will only ever talk about options under the context of my ability to actually walk beside traders and explain the pitfalls of options with live market data. The only way that I can think to do that is to actually record live market data, create watch lists, create trades, do trade reviews, review your trades, and a lot of that would take a lot of my time. And if I'm going to dedicate time, I have to be compensated for that time. Now, I'm giving you this course. I had the option to charge for a trading course. So I want you to think about that. If I would have charged, say, $300 for this course, and I could sell it to 1,000 people, well, how much money is that? That's $300,000. Well, what if I sold it to 2,000 people? Well, that would be $600,000. I'm giving that away. I'm putting that out on the internet because I do want you to succeed. I do want to see traders prosper. But if I am going to be involved at a higher level, then it's going to come at the cost of something else, and I have to be compensated for that. So I added the join button. It's $10 a month, and what you will find behind that join button. All it is exclusive content. I'm not into the emojis and all that kind of stuff. I'm looking for value. So what I'm going to do is post 2 videos every single week for the people who are who have joined the membership for the channel. So it's 2 videos per week. On the weekend, I'm going to create a watch list. We will go over the watch list from the previous week. I'm going to talk about long trades, short trades, returns on trades, how we found those trades, how we were able to pick the best trades based on sector confluence or overall market confluence, which I'll talk about in this trading course. And then I'm going to take it a step further and talk about options. And it's not as simple as just buying an option. There are a lot of things that you have to know in order to avoid the pitfalls of options trading. And I paid an extreme amount of money through losses learning those types of things. And I want to be able to talk about how that applies to live market data as we're actually looking at the candles paint with real-time data. Anyone can take charts and look back at them and say you should have entered there and exited there. Anyone can do that. I want to talk you through real live market data. So each week I'm going to create a watch list. I'm going to go over trades from the previous week's watch list, and I'm going to talk about upcoming trades and things that we're looking for and what options we might buy, what options we should have bought previous, and those types of things. And then lastly, I will actually go over individual traders' trades. Now, I'm not looking for trades that are not what I am talking about or teaching, because really, do you want me to talk about trades that I'm unfamiliar with? The value comes from the fact that I have actually traded for 12 years with my own money. I've taken a lot of losses. I've had a lot of wins. I've learned a lot of things. That's where the value is. So the way that I do it is the way that you're going to want me to kind of go over that with you. So that's the idea behind the join button. So if any of you are interested, you can go there now. You can join. I stopped telling you what the second video was about. So each week you're going to have one on the weekend and one about Wednesday, Thursday. They're both going to cover the same things. It's just updated each week to say, here's the current market conditions. Now, some of you are watching this and you're saying, well, I trade cryptocurrency, or I trade Forex, or I'm international. So me personally, I trade the U.S. stock market, and I trade derivatives in the U.S. stock market, stock options based on U.S. equities. I use TradeStation.com. That is the company that I use, the brokerage service that I use for charting. A link to TradeStation will be in the description below. I've worked out a deal with them. I am not being compensated, but what I have done is figured out how to get anyone access other than, I think it's Canada. So if you're in Canada, I'm sorry, but I do think you can still get access in Canada through other brokerage firms to US-based options and things like that. But for anyone else, you're able to open an account with TradeStation. I believe you have to have a $500 minimum account balance. But once you do that, I will give you my workspace. I'll let you follow along in real time with the exact setups that I'm going over. But through that link, you can gain access to the market data that I use. So it's a $500 minimum account balance. You might have to pay a small fee for market data, and that's it. So it's not a free brokerage. There will be more information about TradeStation and how to open an account with TradeStation if you choose to do so. I don't care either way. Again, I don't get paid either way. But the point is you can get access to US-based equities and markets like through that if you think that you're just restricted to Forex or cryptocurrency trading. I'm going to show you stuff today that moves significantly more than Forex or crypto, and I don't think it carries the same risk that Forex has. But again, that'll be options. I'll talk about that a little bit later in the video. I'm not going to get into teaching options in this video. This is mainly about the ground up strategy of market timing for short-term trades and longer-term swing trades, which is what I do. So again, I'll shut up about that. But if you're interested, you can hit the join button. I want to let you just get right into the information. Please leave me a comment below with questions that you may have. I'll answer those in the newsletter. Give this video a thumbs up if you appreciate me just putting this out there and giving it to you. I appreciate every one of you. I'm thankful for every one of you. I'm so glad that we've gotten to this point in the journey, and I look forward to hearing more from you, learning more about you. And for those that join through the join button, I'm looking forward to working with you with that content. So thank you very much, and I hope you enjoy this. Okay, welcome everyone. Finally, the trading course. Short-term trading and market timing methods. A quick disclaimer before we get started. Everything that I will cover here is for educational purposes only, and none of this is intended to serve as brokerage, securities, investment, consultative, tax, accounting, or legal advice in any way. And it's really important for me to have this disclaimer here. Okay, getting into the meat of the information. I want to start from the ground up to show the context of how we view the markets before we get into specific trading methodologies. Now, we will get into specific strategies, setups, but the mindset and the context is very important. So we must start with price. Everything begins and ends with price. Before we can trade, we have to understand where price comes from. So to understand price, we need to figure out who actually makes the price what it is. The price of a security is determined by what is known as a market maker. But what is a market maker? A market maker is a firm or individual who actively quotes two-sided markets in a security, providing bids and offers. Those offers are known as asks, along with the market size of each. So let's take a look at that. In this column, you'll see the bid on the left side, you'll see ask on the right side, and the price will be in the middle. A market maker provides quotes for a given security, like a stock. Their job is to match buyers with sellers, and they move the price up or down based on the demand from the buyers and sellers at various price levels. Okay, so that was a lot. When a person buys or sells a security, such as a stock or an option, they are buying and selling with the market maker, not with other investors. The ask price is the price that a trader can currently, the ask is the price that a trader can currently buy the security for. So if you were to try to buy a stock, you would have to pay the ask. The bid is what the trader can currently sell the security for. And there's always a difference between the bid price and the ask price. The market maker matches the orders together and gets to keep the difference between the ask and the bid. This is what is commonly known as the spread. If there are more buyers than sellers at a given price point, then the market maker will raise the price until it reaches a level where there are enough sellers to satisfy the buyers. If there are more sellers than buyers at a given level, the market maker will lower the price until buyers can be found to match those sellers with. This is what makes the market price fluctuate constantly. The market makers are matching buyers with sellers. Okay, so we understand that there's a price and there's a market maker moving the price based on the number of buyers and sellers that are out there. But how do we chart that price? In the form of what we call technical analysis. So I'm going to start with the basics. At the start of a market period, using Japanese candlesticks, the current price is determined by the market maker and will be plotted as a horizontal line. So in this instance, we're going to start at $44.35. And notice there's a horizontal black dash at $44.35. If the market maker must move the price up based on more buyers being present than sellers, then a green bar will paint upward towards the new price level. In this example, the price moves up to $44.48 from $44.35. So notice the price point of $44.48 and $44.35 are connected by a green bar. That is because $44.48 is greater than $44.35. If the market maker must then move the price back down to a level of $44.40, the green candle will contract and a wick will be left to show the trader where the price had previously traveled. So let's do that. Let's move the price now from $44.48 back to $44.40. All right. Notice this black line. That is known as a wick. Think of this as a shadow or maybe an indication showing where price previously existed. So what we can see by looking at this wick is that the price opened at $44.35 and it went up to $44.48 and then it retraced back to $44.40. We can tell by the green body that the current price is at 44.40, and because it's green, that means that that is greater than 44.35. And because of the wick, we can tell that the price has gone all the way as high as 44.48. If the market maker must then move the price back down to a level of 44.27, the green candle will disappear as the price crosses back below the open. So if you have the open price of 44.35 and price goes up from there, the candle will paint green. If you have an open price of 44.35 and the price goes lower, so in this example we're going to go down to 44.27, then the candle body will turn red. So the distance from the open of 44.35 down to 44.27 will be red. You see, a candle will paint green, as I mentioned, when the price is above the open of the candle, and it will be red when the price is below the open of the candle. So here's 44.27, and watch what happens. So not only do we create a red candle, but where the green candle previously existed, we now see a wick, which again, we can instantly look at this candle and see, okay, the open is at 44.35. The price has moved as high as 44.48. It then retraced that area, leaving a wick. Then it passed our open and went below the open to 44.27, which left us with a topping tail candle, which is red and has a wick pointing straight out of the top. All right, so now we understand how this price that was created by the market maker is plotted using technical analysis and Japanese candlesticks. But how can we track how much buying and selling is being done at a particular price level? The answer to that is volume. So you'll see volume on charts similar to this. You'll see these Japanese candlesticks, and then just below the candlesticks, you'll see these bars that stick up like a histogram. Those bars are volume bars. So let's talk a little bit more about what that is. Trading volume is a measure of how much of a given financial asset has traded during a period of time. For stocks, volume is measured in the number of shares traded, and for futures and options, it's based on how many contracts have changed hands. In the Forex markets, there is no volume data available. In this example, this volume bar represents more shares traded than the previous volume bar. So just the only thing I want you to see here is that that blue bar is higher than the previous blue bars. That means that there were more shares bought and sold during that period of time, represented by that candle above, than in any of the candles previous. So what we know, so let's put together what we've already talked about. What we now know is that this candle netted more buyers than sellers during this period of time. How do we know that? Because the candle is green. And it did so on higher volume. Well, it did so on higher volume, and how do we know that? We know that because that volume bar is higher than all of the previous. So now we know enough to begin forming the story around what we are observing in what is called the price action. So as the price goes up and down and more candles are formed, that is what is known as the price action. So let's break down what we can already tell from what we've learned just within the first 10 minutes of this video. A large green candle has broken above a recent trading range. That trading range is represented by that orange horizontal line. The reason I put that there is because it's an obvious place where you can see the price has come up to, but has not been able to close above. There's one red candle about 3 candles prior to the big green candle, and you can see that it has a wick up and through the horizontal orange line. That means that price tried to trade above that area, but eventually contracted back. So we know that this large green candle has broken above a recent trading range, and that means that there are more buyers than sellers. The large green candle was formed with a higher than normal volume, meaning that new buyers have stepped in to purchase. The large green candle has broken above the highs of recent red candles. That means that the price is now trading above a level that previously served as resistance and led to selling. All right. Why are we calling that resistance? Because the price came up to it from below,
and was not able to trade above that orange level. Okay, so that orange level served as an area of resistance to the price. All right, so what this means is that the current move, because this green bar broke above that level, it's a big green bar and it's supported by high volume, we know that there is momentum, the price has broken out, and it's done so on higher volume. Those are important things to note. So the next step, let's learn about moving averages and moving average channels. So first we'll plot price. As you can see here, these are just various candlesticks representing a period of time. That can be a daily, a 1 minute, a 5 minute. We'll talk more on that later. But then we have these squiggly lines. I chose to use the colors blue and pink. Don't know why. This moving average has a period length of 5. This will be known as our quote-unquote fast moving average. This moving average has a period length of 15. This will be known as our quote-unquote slow moving average. When the fast moving average is above the slow moving average, this indicates a strong uptrend. But let's stop for a second and talk about what a moving average actually is. And in this case, a simple moving average. A simple moving average is the easiest moving average to construct. It is simply the average price over a specified period. The average is called moving because it is plotted on the chart bar by bar, forming a line that moves along the chart as the average value changes. Okay, so the five period simple moving average, which is blue in this picture, would average the closing values of the last 5 candles. So each one of these candles has a closing price before they move on to the next candle, and this averages those closing values of the 5 previous candles. That 5 is known as the period. It's a 5-period simple moving average line. All right, so once the average has been created, the points are then plotted. All right, so they plot. There's a value for the last 5 average, and that point is plotted on the chart. When those points are connected over time by a line, it creates a moving average line. And that's what we see above. That blue line is a moving average, which is 5 periods in length. A 15-period moving average, or simple moving average, I should say, would average the closing values of the last 15 candles and then use that value to plot a point, just like the 5-period moving average. As these points are connected, the 15-period moving average forms. All right, so we have to learn about moving averages and moving average channels. So just by looking at this, knowing what we already know, when the blue line is above the pink line, we know that the average of the last 5 candles in their closes is greater than the average of the last 15 candles in their closes. That means that there's more upward momentum in recent history. That's why it's indicative of an uptrend. But we're going to look at the area between the 5-period moving average line and the 15-period moving average line. This area that is between these two moving averages creates what I call a trading channel. This is an area of strong support with the 5-period simple moving average is above the 15-period simple moving average. We will frequently look for reversals when the price is in this channel area. So what I am simply saying here is that if the price dips down below the 5-period moving average line, anywhere where you see that yellow shaded in is a very good area for what is known as support, or a place where buyers will come back into the market. So the down move that brings us below the 5-period moving average line, that down move will typically stop somewhere in that yellow range, and then we'll see a reversal back to the upside. We'll talk more about that later as well. First, I want to talk about a very specific candle that we are going to be on the lookout for. I call this a big bull candle. You won't find that anywhere else because I made it up. But a green candle with support between the 5 and the 15-period simple moving average. All right, that's what we want to see, step 1. The second thing we want to see is the close of that green candle higher than the recent open of a red candle. So if you look at the red candle just to the left of the big green candle with the arrow pointing at it, you'll notice that the green candle has a close that is above the open of that red candle. The green candle also needs to close higher than the 5-period simple moving average line, which is just the blue line on the screen. And we want to see that that green candle has higher volume than the previous red candle, which is not shown on this screen. Next, we have what is known as a baby bull candle. It's less effective, and it has just one subtle difference. So this green candle needs to have support at the 5-period simple moving average line. So notice the green candle didn't break into that envelope between the green and the pink. It just came down to the 5-period and found support on the 5-period moving average line itself. The close of that green candle, just like previous, needs to be higher than the recent open of the red candle. And the green candle close has to be higher than the 5-period simple moving average line. That step typically takes care of itself. Green candle also needs to have higher volume than the previous red candle. So, I'm big on examples. You are going to see so many examples in this presentation. Let's talk about an example of a big bull candle. So, the first thing I want to highlight is the candle that I'm actually looking at. And this green candle is a candle that has support between the 5 and the 15-period simple moving average. So we can check the first box off. Number 2, the close of the green candle must be higher than the recent open of the red candle. So if we move 2 candles to the left, you'll see a red candle. This green candle is very clearly closing higher than the open of that red candle. The green candle needs to be above the 5-period simple moving average line, which is blue. Yes, that's the case. And that candle needs to have higher volume than the previous red candle. So we have the previous red candle, we have our green candle, and we have higher volume. I drew a horizontal red line down on the volume bars so that you can see where the volume was previous. And so we have this breakout candle to the upside on higher volume. That obviously leads to an increase in the price. Let's do a big bull candle example, but we're going to use a Forex example. Looking at the Euro US dollar 60-minute time frame, we won't have volume, but I do want you to pay specific attention to this. If you're a Forex trader, a lot of the value in this video is going to be up front, because as I get into the strategies later in the video that I actually use, it's going to be much less about Forex. But I would ask you to keep an open mind as a Forex trader when we cover this stuff, because I believe that what I am going to show you is significantly greater than anything you're going to be able to do in the Forex market. But again, you'll have to stay tuned to see what that's all about. Here we have a green candle with support between the 5 and the 15-period moving average lines. Then we have a red candle. There's 2 red candles. We could use either one of those, but the green candle close is higher than the open on those red candles. And that green candle is above the blue line 5-period simple moving average line. And the green candle needs to have higher volume than previous red candles. We won't have that on this Forex example, but you can still see it works out really well. So now let's do a baby bull candle example. This is Bank of America on the daily chart. The green candle with support at the 5-period simple moving average line. You can see that right here. The green candle closes higher than the open of a recent red candle. We have that. Green candle above the 5-period simple moving average line. Yes. Then the green candle has higher volume relative to the previous red candle. So if you just go one step left of the green candle, look towards the bottom, you'll see that this green candle is breaking out on higher volume than the red candle sold off at previously. That leads to a lot of appreciation. Now we'll do a baby bull candle example on Forex. So we have this green candle that has support at the 5-period simple moving average line. That green candle has a close higher than the open of a recent red candle. We're above the 5-period moving average line. And then we don't have any volume to work off of, but you can see this example. On the topic of candlesticks, next we need to get into some important candlestick patterns, or things that will help us while we are charting. These candles are what I call reversal candles. I'm really bad at calling things their proper names because I tend to make stuff up. So don't hold me to a specific name. Just understand that I'm naming it what I want to name it. I'm going to call these candles, and I'm going to group a bunch of them into, you'll hear people talk about candlestick patterns like shooting stars and hammers and all that kind of stuff. I'm not going to go into all the details. I'm going to group a lot of them together. I'm going to call any of these candles topping tail candles. So topping tail candles come at the end of a series of moving or up moving candles. Let me say that again. Topping tail candles come at the end of a series of up moving candles. They are characterized by their long wick at the top with relatively small body. So just notice on this candle, there's a really large wick and a small body, but that wick is very long and it's on the upside. So essentially what we can tell from that candle is that at one time it was a tall green candle, and sellers came in and drove that candle all the way back down, very close to where it opened. So let's take another look at another example with a smaller body. This is a topping tail candle. You can see that right after this topping tail candle, we had a series of red candles that led to a significant down move. Here is another topping tail candle. This one actually has a red body. The color of the body does not matter to me. I'm looking at that topping tail. Then we have what are known as bottoming tail candles. So bottoming tail candles come at the end of a series of up-moving candles, just like topping tail candles do. They are characterized by their long wicks at the bottom with a relatively small body.
All right, so I'm just coming back to you just to give you a little bit of a break and to summarize a little bit about what we just covered. The point of the first part of this course was for you to understand where the price comes from. So that's really where we have to start, is where does the price come from and who determines the price? And so that's why I introduced you to the market maker. We then figured out how that price translates over into what we call technical analysis in the form of Japanese candlesticks. So understanding how the price moves up and down helps you understand the psychology behind each candlestick. And then I wanted to talk briefly about volume, how we can measure one candlestick against another to see what type of buying and selling took place during that period of time, the moving averages and the moving average channel, which is really important. And then next we're going to get into actual charts. We're going to talk about what this looks like in real time and how we use multiple time frames to pinpoint where the buying and selling has been happening and where it is most likely to happen in the future. So at this point, by now, you should understand where the price comes from, who creates that price, how it is plotted on a chart, how moving averages work, how volume works, what it represents, and the fact that there is a thing such as support or resistance based on the area between the 5 period and the 15 period simple moving average. If you understand those things, then you should go on into the next part of the course. I hope you enjoy.
All right, so now that we've talked about price and how that's formed, let's talk about who typically moves the market prices the most. So here's a quick list on the right-hand side. Endowment funds, commercial banks, hedge funds, pension funds, mutual funds. Essentially very large institutions. So here's the thing to know. Institutions cannot place their orders all at once due to the size of their orders. So at a given price point, they may be able to get, say, 30% of their orders filled, as represented by the top of the picture that you see, while they still have 70% of their orders outstanding. That's the bottom of the iceberg, the part that you don't see. And because there are only so many sellers at any given price, when an institution places a large order to buy, it will regularly exhaust all of the sellers at a given price point. This forces the market maker to move the price up in order to find more sellers for the large institutional buyers. For this reason, institutions cannot buy all their shares at one time. They must buy, wait on the price to pull back slightly, and then buy again. This also creates a very strong uptrend. So I just want to show you an example of a chart where we can clearly see these large institutional buyers coming in simply using the information that I've already covered in this video. So let's start in an area of 25.11. You can see that on the left-hand side of the screen. And I am circling a large candle. Now, the blue line is not above the pink line, but that candle is a large green candle that closes above the recent red open candle. It's doing this on higher volume, and it is higher than the 5-period simple moving average line. All right, so that's 25.11. You can see that big order came through. Next at 25.25, you see that green candle breaking the top of that recent red candle. We now have an uptrend indicated by our moving average lines, and that green candle broke the top of that recent red candle on higher volume than normal. It's higher volume than the previous green candle, but it's also higher volume than that red candle as well. Here again, we see higher volume, a green candle breaking a recent red candle. Now that volume on that green candle is not higher than that red candle's volume, but that volume is greater than the previous candle, which means that there's more activity happening during that period than the previous candle. And then again, we see buyers coming in. This is actually one of those big bull candles. Forgive me if I accidentally say bear. It's not, I don't mean to say bear. I mean to say big bull and baby bull. But if you hear me say bear, I meant to say bull. So I apologize about that if I do that. But you can see this candle is on higher volume than the previous red candle. The close is above the open of that red candle. And this is just another example of buyers coming in and driving the price even higher. The next candle is, what is that? Look at that. That's a topping tail candle. And you'll notice if you look to the right-hand side of that candle, the price does not immediately reverse, but the topping tail candle is a very strong indication that the uptrend is almost over. So it's something that we always pay attention to, especially when it has as high a volume as this topping tail candle has. And you can see that in the near future, the price does reverse down. How do we track the giants? So if you saw the video that led up to this video, if you saw that video, you know that I was talking about tracking giants and looking for their footprints. Well, by now, hopefully you've put it together that the giants are the large institutions that are dictating most of the buying and selling in these securities. But how do we track these giants for the best setups? So the first thing we have to do is we have to find momentum, and then we have to use our time frames to track specifically where that momentum is and when that momentum is. So the first thing we have to understand is what I call market hierarchy. What does that mean? What it means is you do not just arbitrarily start by looking at ticker symbols. You have to start from the top and work your way down, because there are things that are more powerful than your specific ticker that you're looking at. And the most powerful thing are the broad market indices. Now, for this example, I'm going to cover US market indices, but whatever country you're in, it will work very, very similar to this. So here in the US, we have the Dow Jones, we have the NASDAQ Composite, and we have the S&P 500. There's also the Russell and a couple others, but for this example, I'm only going to use those broad market indices. If you don't know what those are, pause the video and Google those right now. But just below the broad market indices, we have market sectors. Now, if you don't know what a market sector is, you can look up what are stock market sectors on this channel. I actually have a separate video, I believe, about the broad market indices as well. So you won't actually have to Google it. You can actually just go look at some of my content. You'll also figure out that I planned on getting here from day one, so I started my videos out as a reference for that I could use in the future when I actually got into the meat of trying to show people how this all works, or at least my methodologies for making it work. So what happens is the broad market indices funnel down through market sectors, which eventually lead us to an individual ticker. All right. So here's a hierarchy example. Let's say that we start with the QQQ, which is really just the NASDAQ composite, or the NASDAQ, if you will. The QQQ is an exchange-traded fund that shadows the actual NASDAQ. So let's say that we are interested in the QQQ going up. Well, after we realize that the QQQ is likely to go up, we then need to find a sector that is causing the QQQ to go up. We're going to be able to find that by looking at the volume and price information that I've already covered in the video. After we find that the healthcare sector is one of the sectors that's driving the price movement in the overall indice of the NASDAQ, well, then we will know that most of the buying and selling activity is happening within that specific sector. So we want to find a stock in that sector that is also attracting that level of institutional attention. In this example, we could use Gilead Sciences, GLD. All right, so we start at the top with the overall broad market. We then move down through sectors to figure out what is the hot sector, and then we find the hot stock in the hot sector. Here's how I look at this in my head. Imagine that there is a giant waterfall on the edge of a cliff. A very pretty waterfall, but a giant waterfall. At the top, the river is represented by the QQQ. So what's upstream is the QQQ. That giant waterfall is indicative of the healthcare sector in this example. And you know the direction of that water is coming straight down. Now, we're not thinking about the direction of the stock, but I'm just talking about, for the purposes of this example, QQQ is at the top of the waterfall. The healthcare sector is the waterfall, and healthcare stocks are the peaceful water at the bottom of the waterfall. Now, you have an option here. A lot of people incorrectly start by looking at the healthcare stock itself. Well, you need to understand that even though the waters are calm where the healthcare stock is, just upriver, the whole healthcare sector is represented by a waterfall. Now imagine you're in a boat, and you're in a boat right around where the healthcare stock is in this picture where it's written out. Well, that's calm water. Now you have the option. You can either take your boat upstream and fight against the current, or you can turn your boat around and go with the current. So my point is that if you were not aware of the current, if you're not aware of the waterfall, if you're not aware of the directionality of the river, in this example, the broad market indice and the sector, then you may be trying to take your boat against the tide, against the flow of the river, and it's not going to work. It's always easier to go along with the things that are creating the momentum in the first place. Just imagine you're in a boat here and you come up against that waterfall. Will you be able to scale that waterfall with your boat? No, absolutely not. But if you were at the top of that waterfall, would you be able to go down the waterfall in your boat? Well, you'd die, but the point is that would be a lot easier to accomplish if the goal was to just go in the direction of the river. So I think I've made my point. This is how I look at that market hierarchy. So when we're trying to find momentum, I use scanners. This is the very specific scanner that's offered by TradeStation. Again, I'm going to continue to harp on TradeStation because it's the platform I have used for a decade, and there is simply no reason whatsoever for me to leave this platform because, in my opinion, it's the greatest that there is. All right, so first thing I do when I set up my scanner is I want to scan all stocks. Now, I'm looking all stocks in my platform. They're not all stocks globally. It's all stocks essentially in the US or North America. So I'm looking at all stocks. And then the criteria that I'm using to scan for is I want the last price to be greater than 25. You can go lower if you want to. You can use 10. I try to stay away from penny stocks just because penny stocks can move with a lot of volatility, and they can do so on retail investment, not necessarily institutional investment. The higher the price of the stock, typically, especially if it's paired with a lot of liquidity and a lot of capitalization, the higher the price of the stock, the more buying power it takes to actually move it. So it's easier to kind of see where those institutions are. And then I'm looking for the percent change for one day to be greater than 1. That's just 1%. And so once I get those results, the results will come out like this, and they're alphabetizing the ticker symbols on the left. But I want to organize this by percent change over one day. So what I will do is I will sort that column by clicking at the top of the column, and I'll sort it by highest down to lowest. And so then I start on the left side and I go through those symbols and I start looking. I start looking for evidence. I start looking for those giant footprints. But this right here helps me do a lot of the front end work to understand where the momentum is at this very moment. And once I find a symbol, then what I will do is I will definitely make sure that I am paying attention to the sector that that symbol is in as well. But there's going to be a whole breakdown on that process later in this video when I get very specific into the profit market trading strategy. All right, going back. So we've talked about how to find momentum, but now we need to understand how to track institutional buying and selling using our time frames. You might say, what? Using time frames? Stay with me here. All right. First, we must understand how time frames work in the first place. All right. So on the left side of this yellow line, I have one green bar, and we're going to say that green bar is a weekly green bar. The thing that's very important to understand is that weekly green bar is made up of 5 daily bars. And so what happens during the week, you can combine all of it to create the one weekly bar. So we have a small move up on Monday. We have a move down on Tuesday, where the close is very similar to the close on Monday. Then we have a small move up on Wednesday, a big move Thursday, and then some of that move is given back on Friday. And then just before the close on Friday or sometime during Friday, we can see that wick on that Friday candle. We know that the price comes up a little bit, but it still stops just below, the close of Thursday's candle. And when you combine all those candles together, what you get is that one weekly candle. So it's really important to understand that the daily candles are simply doing the bidding of the weekly candle, because it's what they are. You have to combine all of the daily candles to even get the weekly. So we always want to pay attention to our largest time frames first, because the smaller time frames are just breakouts of the larger time frames. They're not calling the shots. The big time frames are calling the shots. So here's another example. Let's just say that this candle is a 60-minute time frame. Well, if we had a 60-minute time frame and a 20-minute time frame, we would have three 20-minute candles for every 60-minute candle. And it's not like there's just 3 for every one. Those 3 20-minute candles actually create the 60-minute candle. So we can either look, if we want to see more detail, we can look at a 20-minute chart to see 3 candles broken out, or we can see that same information by looking at one 60-minute candle. It's the same thing with a 3-minute candle. 3-minute candle would just be broken out into 3 1-minute candles. And that's how that works. Here's another analogy for you. This is how I view it. So not only do the daily candles make up the weekly candle, but it's like zooming in to the weekly candle. So if we just let our weekly candle, just for the sake of this example, be represented by the Earth as a globe. When we look at a daily chart as seen on the right side of this slide, what we're really doing is zooming into, we're getting closer to that globe to see what makes up this globe, what makes up what we're seeing in these weekly candles. And what makes that up are daily candles. And in this example, the daily is represented by the United States. I'm really just kind of, looking at the area in which I live. So we can look at the Earth, we can look at the globe, but if we want a better picture, if we want a clearer picture, then we just need to zoom in some more to see what's going on. And that's what we're seeing here represented by the daily. Well, the daily is still kind of big as well. So what if we want to see more detail than what we can see on the daily? Well, then we can use a chart like a 60-minute chart and notice that we got a lot closer than we were looking at the daily. So now I can actually see that there are interstates. I can see the names of towns and cities. I can see some lakes. There's actually a lake on this picture that I grew up on. And we would only be able to see that on the 60. But if you just looked at the 60, if I just showed you that, and I didn't show you anything else, and you didn't recognize the names or the roads, you'd have a very hard time knowing that that 60-minute chart was actually the east coast of the United States. You see, you couldn't see that because you'd be too close. You need to know by looking at the daily that that's the United States. And if you were just looking at the United States and you knew nothing about the Earth, you would not know that it was a continent on a sphere that's floating through space. But you would know that if you looked at the weekly first. So that's really the breakdown on time frames and how they work and how I think about time frames. Again, this is another example I just want to show you. The weekly candle is simply created by combining the 5 daily candles. Sorry, I hit the microphone. 5 daily candles from that week. It looks like this. You see, when you combine those 5 daily candles, you get the weekly candle. They are all inside one weekly candle. So let's actually look at some charts. So here's the weekly chart above the yellow line in this same exact time period. So what I did was I just broke that same time period out into a daily, and this is what you can see. So essentially what we're doing is we're breaking each one of those weekly candles out into 5 smaller candles. And when we do that, we're left with the chart that is a daily chart. And if we want to break that daily out, now remember, this is for stocks and U.S. stock market, so it's a little bit different for Forex. But a daily chart in the U.S. only plots itself from 9:30 a.m. Eastern Standard Time to 4 p.m. Eastern Standard Time. So it's only 6.5 hours. So that will break out into that number of 60-minute candles. So if we break out those daily candles, each one of those is going to get about 7 candles to represent a 60-minute time frame. Now, I do understand the math is not perfect on that, but you'll understand. So now we know we're looking at a weekly chart. We're zooming into the candles of the weekly chart to break out into 5 candles apiece to look at the daily. And if we want further detail, we will look at the 60-minute chart. But understand, if we look at that weekly chart, you see how that red candle came down to that 5-period moving average line and the price bounced? Well, you can see that as the bottom of that big, strong uptrend that you can see on the 60-minute time frame. And if you're just looking at the 60-minute time frame, it'd be very hard to know that the price was about to reverse there. It's only by looking at the weekly that we can tell, okay, that's a strong support area, and this may be a place where institutional buyers may come back in. Pretty good stuff, right? All right, so this is what we're looking at. If we're talking about giants and giant footprints in institutional investors, if we look at a weekly chart, all it is a track record of what happened in the last week. All right, so if we see strong institutional buying power, we see these high volume bull and baby bull candles in these moving average envelopes, and we see these candles breaking above recent red candles and things like that, and we see that on the weekly chart. What that tells us is that within the last week, there were institutional buyers interested in a very specific ticker symbol that was in a very specific sector that trades under a very specific broad market index. So essentially what we're doing is we're tracking down that buying power, and we're using the weekly chart to see where these buyers were in the last week. Now, when we refine that down and we find these buyers on a daily chart, well, now we know where those buyers were in the last day. All right, so at the end of the day, we can say, okay, look, this is where buyers were. They're buying into a stock today that they were actually buying into last week, and they've been doing this for some time in this sector. We would then use the 60-minute time frame to find institutional buyers in the same symbol, and now using the 60-minute time frame, we'd be able to refine it down and say, okay, well, not only do I know where they were last week, not only do I know where they were yesterday on the daily, I now know that within the last hour they were buying into this ticker. And you can continue to go down. So if you want to go down from the 60 down into like a 15-minute chart, you can find where they were in the last 15 minutes. Then you can find where they were in the last 5 minutes. And you can even find where they were in the last 1 minute. But you have to start large and then go small. And if you do that, you can track down exactly where these purchases are taking place. So just a charting example before I get into things that are a bit more complicated. What I want to show you is if you look at the red down arrow on the left chart, okay, that's a 15-minute time frame of general dynamics. You just have to take it for me because there's nothing to the left of this chart. That green candle is essentially a big bull candle, because previous there was a red candle that was in the envelope. This big bull candle pops out on higher volume. So what I want you to see is that as we look at that candle, now we're only looking at the left side of the screen. We're looking where the down red arrow is. Okay. Actually, I'll use my cursor so that you can see it. We're looking at this area right here. And if we look at this area, we move over into a green candle, and then notice what I said about the institutional buyers. They have bought everything they can buy, and they need the price to come back down a little ways in order to get a better price to try to buy more, because they couldn't get all of their orders filled at one time. So this down move, when it's broken out into 5-minute candles, so there'll be 3 candles over here for every 1 candle that's over here. This down move, this pullback right here where my cursor is actually right here on this chart. So after we know the institutional buyers are here, the price drives up, it pulls back, and now we're waiting on institutional buyers to show up on the 5-minute time frame, and they do. Right here on this green candle, you come down, you see the higher volume spiking up. We obviously are above the 5-period moving average line. That line is above the 15. We've come down into this envelope. We found support. We're knocking out the opens of recent red candles. This is an entry at 154.82. And that's what we're doing. We're using 2 time frames now to refine our entries to figure out how we can piggyback onto the backs of these institutional buyers and sellers. As we move forward, we get another one of these candles. So we get another one on the monthly chart. I don't know why I said monthly chart. On the 15-minute chart, we have another big green candle on higher volume. It's taking out the top of this red candle. And so we go, okay, really, this candle was formed by the move that we entered into here on the 5-minute chart. So what happened as the 5-minute manifested the data upward, this price action, when you break these 3 candles out, created this big green candle on the 15-minute time frame, which was a baby bull candle. All right, so now we wait on the pullback, which is very subtle in this example, and we get a higher volume green bar on the 5-minute chart. So now we know within the last 5 minutes the buyers have been here. And then what happens is that price is going to drive higher from there. As the price drives higher, it creates another baby bull candle on the 15-minute time frame. I love this stuff. This is fantastic. I hope that as you're watching this, it's as exciting for you as it is for me, because I've been looking at this for years and years, and I just love the way that this works. All right, again, this big up move will create a bullish candle. So we have a big bull candle here on the 15. Literally, we're getting a breakout at the exact same time on the 5-minute. This is one thing I will accept, is when you use time frames that actually close, or in other words, the bigger time frame is evenly divisible by the smaller time frame. Lots of times these candles will close at the same time. And we have this big high volume bull candle on the 5-minute time frame at the same time that we have this bull candle completing on the 15-minute time frame. So there's no need to wait on the pullback. You can actually just enter right there, and that is just going to end up creating another big bull candle. So for this, I'm going to use a similar chart, but and we're going to look at some of the same stuff, but now we're going to look at the price on the right-hand side of the chart, because when you trade in real life, you won't have any data to the right side of the chart, because that will come in real time. So you don't have the advantage of seeing what worked and what didn't. You have to do it in real time as the candles form. So here we go. We're going to call this leg 1. So the first leg is on the larger time frame, and we need that bull candle. So this is a baby bull candle on the 15-minute time frame, and that's represented right here on the 5-minute time frame. All right, so what's going to happen next is we're going to continue to move higher. We're waiting on that pullback. We're waiting on that pullback on the 5-minute time frame. Here, we're still waiting. I'm moving the candles forward one candle at a time on the 15-minute time frame, so that every time I move slides, we get one more candle on the 15-minute time frame, and we get 3 more candles on the 5-minute time frame. So eventually what happens is we get a small sideways pullback, and then we get leg 2, which is, for us, was a big bull candle on the 5-minute chart, and we would enter this trade to the upside. So let's see what happens. It continues to pull back further, and then all of a sudden we move into an up move as the next bull candle is formed on the 15-minute time frame with higher volume. And that's how that works. But the big thing is, unless you find the momentum first, this whole bull candle, baby bull candle, looking at volume, all that stuff, it only matters in the right environment. And that environment comes from finding very hot stocks in hot sectors under a market where you understand the directionality. And we're going to continue to dive into that as this video progresses. As we go forward, I'm going to dissect all of that. We're moving with baby steps right now. So don't think too far into this. I just want you to understand and grasp what I'm telling you right now, and I will explain more as this video goes. Okay, so we can now refine our entries by adding a third leg, which is a third time frame. So we'll have leg 1, leg 2, and then leg 3. So let's take a look at the order of execution review. For this example, leg 1, we're going to find it on the daily chart. So what we will do is we'll wait on a bull candle with higher volume to break out above that 5-period simple moving average line. Here's a very important part. If you don't take anything else from this course and you just took this one nugget of information, it's going to serve you very well. You must wait on a candle close before moving to leg 2. We never do anything while the candle is still forming. So a weekly candle closes on Friday. A daily candle closes at the end of this day. We do not count any candles as being completed until they're actually closed, because you could have a really large, big bull candle on the daily chart that in the last 10 minutes of the market day reverses and turns into a red candle. I've seen it happen too many times to count. So we only count what is locked in time, because once that candle closes, it'll be charted like that forever. It can't be modified anymore past that closing point. So you must wait on the candle close before you move on to leg 2. So we have to have a complete day. After that candle closes, you then start looking at the 60-minute chart. You wait on a pullback after leg 1, and you wait on a bull candle with higher volume to break out above the 5-period simple moving average line. You must wait on leg 1 candle to close before starting. All right. And then only move to leg 3 after leg 2 bull candle closes. So we're going to wait on that same bull candle, the same setup on the 60-minute. So what is this telling us? This is telling us that in the last day, we've had a big bull candle. There are big buyers that are interested in a hot stock, in a hot sector. And not only that, this stock is in an uptrend. A lot of buying has been taking place. And so that has happened in the last day. We then watch the 60-minute chart and we go, okay, is it going to happen today? Are they going to come back? And then after they come back in, we go, oh, wow. And then the 15-minute time frame, or leg 3, is just used to refine our entries. You can enter no problem on the 60-minute time frame, but the 15-minute chart will give us a better entry, because I personally like to see profit in my position shortly after entering it. I can't stand entering a position and then having it go against me for a long time while I have to cross my fingers to hope it turns back in the direction that I want it. So leg 3 helps us with that. So we're going to wait on a pullback after leg 2. Wait on the same bull candle setup with higher volume, break out above the 5-period moving average line. I know I sound like a broken record, but I really want to get this in your head. You must wait on leg 2 candle to close before starting. Then only move to enter the trade after leg 3 bull candle closes. We're going to look at an example. So here on the daily chart, we're looking at Marathon Oil. This has literally happened in February. So this, at the time of recording this video, this happened last week. So we have a big bull candle on the daily time frame. Perfect. The other 2 time frames show you they looked like when the big bull candle formed on the daily chart. Now I do realize that the green line is below. The green line is below the pink line on the daily chart, but we're not using this for a trade entry. We're just trying to find large investors. And so that's what we see here on the daily chart. And the 60-minute and 15-minute, I just have them plotted so that you can see what they looked like at the same time that the daily was doing its thing. So what I did now is I moved forward 1 candle on the daily chart. 1 candle on the daily chart is going to be about 7 candles on the 60-minute time frame, and then it's going to be almost 30 candles on the 15-minute time frame. All right, I don't have enough space to show you all of that. I'm just going to show you what it looks like day to day. So what we're waiting on right now is an opportunity for a pullback and an entry on the 60-minute time frame. So as I move, because we had to skip forward a whole day, I want to point out, I'll use my cursor again, that at the start of February 5th, leg 2 actually formed. Leg 2 formed by so previously we had support here in this envelope on the 60-minute time frame. We had a gap up, and what I do is I consider this gap a part of this candle because it is momentum. If you had all sessions turned on, or you looked at pre-market activity, you would actually see a lot of trading going on here that led to this move to the upside. But we have this big bull candle here on the 60-minute time frame that went up a little ways, and it pulled back on this wick. When it pulled back on this wick, it gave us a pullback on the 15-minute time frame. And then this candle right here, which is the same as this candle, presented itself on higher volume as a bull candle. So we entered the trade on the 15-minute time frame. All right, so I want to show you a couple of things here. So this is where we entered, and this is where that area is on each charting time frame. So we entered at $8.06, and you can see down here we're already at $7.94 at the close. So we're not profitable. We're not profitable at this moment. But I do want to talk about what happens next, and I want to talk about stops. So here we place our stop at $7.80. Why? Because it is at the base of the candle from the time frame we're trading. We're actually trading this middle time frame. We're using this larger time frame in leg 1 as an indication of where these large buyers are, and we're entering the trade on a pullback. And then this chart, the leg 3 chart, is just refining our entries. That's really all that it's doing. And sometimes it turns out well for us and gives us a great spot to enter, and other times not so much. So it's really up to you if you even want to use this third leg. But I just wanted to present it to you. But we would put our stop at the base of this candle. Now I understand the base of this candle is here, but remember, I look at it as one big green candle because this is where the previous candle was. This is where this one opened. This area, that gapping area, is a bullish gapping area. So I placed the stop right at $7.80. If we move forward just one day, look what showed up. A huge bull candle on the daily time frame. So we entered at 806. We went down to 794. At the end of this day, we're up at almost $9. It's a fantastic return on just a stock trade itself. And one of the things that I want to mention is that when we're looking to possibly exit this trade, we're getting some stuff here. We see that's topping tail candle right here. And then we have this doji candle. I didn't cover that in this course, but this is at the top of a move, a candle that has wicks on either end, but no body. That's showing a fight between buyers and sellers where no one really won out. So we have a topping tail candle. Shortly after, we have this doji candle. That's indicative of a place where we would look to exit. Plus, we have a great profit in this trade. So we can say that we took it from $8.06 to roughly $9 in this example.
All right, so I just wanted to stop one more time and review. So in this last section, what you should have learned is that large institutions are not able to just readily buy and sell securities like you and I can. Because of their buying power, they're only able to get filled at a certain price before they exhaust all the sellers at that level. So what that means is unless they want to continue buying into this position at a more expensive and more expensive and more expensive price, they have to wait on the price to come back lower so that they can take another bite, if you will, which drives the price up. What this does is it leaves footprints. There's always evidence of this type of thing happening. So hopefully from this section, in addition to the fact that these large institutions are really in addition to learning about the fact that these large institutions are really the ones that are moving prices in the market, I hope that you've also learned that there are ways to look at price action to figure out where this buying and selling is taking place. In addition, we can use time frames, weekly time frames, daily time frames, 60-minute, 15-minute, 30-minute time frames to be able to observe what is happening over a specified period of time. So if we can find these patterns on a weekly chart, well then we'll know that as of last week, that buying and selling was happening right here in this sector, in this security specifically. So we don't know if they're going to show back up tomorrow, but as of this last completed weekly candle, they were here. And then when we have a completed daily candle that shows us something similar, then we go, okay, now we know that within the last day, they've been here. When we take it down to a 60-minute time frame, which is really just a breakout of the candles within a daily time frame, we're able to go, okay, well look, institutional buying and selling is happening right here in the last hour on this security. And then it's our job to recognize that and try to exploit it. So I want you to pay very close attention because so far I've talked about how to see that evidence, but it's really just been a hindsight thing. So what I'm showing you up until this point is how to catch the tail end of the move by waiting on a big bull candle, waiting on that pullback, looking for higher volume on a smaller time frame, getting in based off of that, waiting on a pullback. But most of the move has already taken place by the time you enter when you look at it that way. So what's happening in the next part of the course is I'm going to show you the way that I look at it. And the way that I look at it is I want to anticipate the next big bull candle. And I like anticipating the next big bull candle on the weekly chart because that gives me time to enter my trades, exit my trades. News events really have no bearing on what's happening. I'm able to stay in these positions for days, sometimes weeks at a time, and let my returns just accumulate and accumulate and accumulate. But I get there by anticipating the big bull candle, not responding to the big bull candle. So that's coming up next as I get very specific into the actual strategy that I use and what then translates into the options trading that I do. Now it works great for equities by themselves. So if you can trade long or trade short, that works out really well. And I would suggest that you do that before you even entertain the idea of options. But it'll speak for itself. I just want you to see the next part. I'm excited that you're here. I'm excited that you're about to see this. And I'm really excited to share this with you. I hope you enjoy it.
All right, so getting into a little bit different order of execution. This is my personal favorite. In this example, leg 1 is the weekly chart. Leg 2 is found on the daily chart. And then leg 3 is the 60-minute chart. Now, I'm not going to go through and read the process of each one of these like I did previously. You can pause it and read it if you would like, but it's the same process that we used earlier. One thing I have done just to show that this can be done this way, you'll have more setups doing it this way. They may not work as well as the previous way, but this is certainly a way that you can trade this. The weekly and the daily have had volume removed in these examples. So we're going to start right here with leg 1. In leg 1, because there's no volume, we're simply looking for a big bull or a baby bull candle without the volume. Everything else still needs to be present. Just the volume is not there, similar to what I showed on the Forex examples earlier. But here we're obviously using a stock. After we move forward with leg 1, every week is going to create 5 daily candles. So that's what we see is there have now been 5 additional daily candles added to the screen. And leg 2 showed up in these daily candles. So as we move to the next week, which on this slide on the weekly chart, that green candle is still circled. That's an error of mine because we moved forward 1 candle. It should be the red candle on the weekly chart circled. But nevertheless, leg 2 shows up after a pullback. Leg 2 shows up after leg 1. And also included in this is that leg 3 shows up on the 60-minute time frame as well. So we've entered this trade. Notice on leg 3, we do have the volume. We do have the big bull candle. And so we would enter leg 3. Right here, we would place a stop at the bottom of the candle on our trade chart, which is leg 2. So you can see that big green candle just below the wick. I placed a stop at 362.03. And I entered on the 60-minute time frame at 380.60. As we move forward, you can see what happened. We're already above $400 at an entry of 380.60. And I want to point out this bottoming tail candle right here. So that's something that I just want to point out just so that it can be seen. And then I am just going to move forward, assuming that you didn't exit on the bottoming tail candle, which would have been totally acceptable if you did. That would have been a very good, profitable trade. Had you moved forward until we reached a more definitive topping tail candle, as we can see here, then the price has moved all the way up to $440 from a $380 entry. So it's just another way that you can kind of do this. But all of that's nice. All of that's grand. I just wanted to kind of show you how the time frames work. I wanted to show you how the institutional buying comes in and then wanes out and how we can kind of refine that. But all of that really leads to this point in the video right here. And this is the profit market strategy. This is what I use. This is what I show people how to use whenever I work with someone one-on-one or anything like that. And now I'm just going to give it to all of you to use going forward, or to take pieces of it, or to not use. It's really up to you. But the first thing I have to introduce is a new indicator. I get this question all the time. Should I use stochastic fast? Should I use stochastic slow? Should I use RSI? Why don't you use a StochRSI? So at the bottom of the StochRSI, you will see the settings. So the RSI length is 12, the stochastic length is 20, the moving average 1 is 3, and moving average 2 is 5. So the settings are there, so you don't have to ask me what those are. And I'm actually going to include the easy language, which is the language used by TradeStation, the platform that I use. I'm going to include that, a link to that easy language, in the description. And I'm also going to include other languages for this indicator as I get them. So what I'm asking you to do is, if you're using MT4 or TradingView or Thinkorswim or any other charting platform that I don't use, what I'm asking you to do, if you have the ability, is to create the code. Again, I'll give you the easy language code. Create the code as it's needed for your platform. And if you'll send it to me, I'll update this video so that in the description, you'll be able to find links to the different codes that are necessary for the different trading platforms. And that's really the only way I know how to do that, is if you all give back and help me with that, because I'm very unfamiliar with other trading platforms, even though I get those questions all the time. I'm very unfamiliar with those because I've never left TradeStation. I've never had a reason to. And anytime I have experimented with other platforms, I've always just been floored by really, in my opinion, how bad they are. Order executions, streaming of data, accuracy of data. It's only been a problem. So I just always go back to TradeStation, which I never leave, but sometimes I'll have multiple brokerage accounts at different places, and I always just end up bringing them all back to TradeStation. But the stochastic RSI indicator, this is really an indicator of an indicator. Well, how so? It is used in technical analysis to provide a stochastic calculation to the RSI indicator. This means that it is a measure of the RSI relative to its own high or low range over a user-defined period. The stochastic RSI is an oscillator that calculates a value between 0 and 1, which is then plotted as a line. Here's a bold line that I want you to pay attention to. This indicator is primarily used for identifying overbought and oversold conditions. That is what we are going to be using it for. So here's a brief chart of SOXL. This is a semiconductor ETF, and I just want to point these areas out to you. All right, so anything below this 20 line is considered oversold, which means that the next likely direction is to the upside. Now, when we combine that with all of the information that I've presented to you in this video, what we're able to do is say, okay, we have a very strong uptrending stock in a very strong sector during a period of the market cycle where our next move is expected to be up. We're going to cover more of that. I'm going to get really specific into that detail here shortly. And what's happening is during this very strong uptrend where there's been a lot of institutional buying, we have this oscillator that is oversold, which means that the next likely direction is up. And so on this chart, I can show you 4 examples in the last 6 months or so where this indicator has reached an oversold area. And then I'll leave it up to you to figure out what happened after it was oversold. Here is MicroStrategy Inc., MSTR, same thing. You can see that the stochastic RSI, both the red and blue lines, that's another important thing. Both the red and the blue lines are both oversold, and that leads to, well, this is a daily chart. I'll go ahead and here's a little spoiler. These up moves that you're seeing on the daily chart are really just baby bull and big bull candles on the weekly chart. This is how they're formed. All right, LRCX daily, another example. We have a very strong uptrend on a very hot stock in a hot sector. And we have the stochastic RSI being oversold. And then shortly thereafter, a very large up move, which creates the bull candles on the weekly chart. And then here's one last example with ticker symbol EXAS. All right, so now let's make this a little bit more exciting. Let's add the weekly charts for the best setups. So on the weekly chart, I don't have a stock RSI. I don't need a stock RSI. I'm simply looking at volume here. So right here in November, you can see the stochastic RSI is oversold, and that leads to a big up move. And I just want to show you, you see that big green candle on the weekly chart? I'm pointing straight down to the volume so that you can see that that is a big bull a big bull green candle. I tried to say it right, still didn't say it right. Big bull green candle. You see that the support came down between the moving average envelopes, between the 5 and the 15. There was support found. It led to a big green candle on higher volume. That's what that move is. So understand, at the time when that stock RSI was oversold and below the 20 line, that big green candle was not yet there. We only had the red candles. It was the subsequent move that came out of that stock RSI going from 20 up to levels of 80 that actually created that big bull candle on the weekly chart. All right, so here's another example. Stock RSI has been oversold, and we have a setup eventually that manifests itself, and it creates another big bull candle on higher volume on the weekly chart. And then here's another example. And what do we get? Another big bull candle on the weekly chart. So what we're doing here with this strategy is we are anticipating the big bull candles on the weekly chart before they are there. And we're using the footprints, the evidence, the ability to find momentum on the charts to figure out where the next big bull candle likely is. So in the first examples that I showed you, we were waiting on the big bull candles and then trying to take advantage of kind of stair steps of buying opportunities that came after those big bull candles. In this example, which is what I use for options trading very specifically because you need a lot of volatility and you need the timing of your trades to be very accurate with options trading. But with options trading, this really matters. I'm anticipating these big bull candles, and when they show up, the returns are absolutely ludicrous. We'll talk more about that here shortly as well. All right, here, same thing. I just color-coded these so that you can see them a little bit better. So if we look at the green example with the arrows, you can see there's a big bull candle that formed on the weekly as a result of the StochRSI being oversold on the daily chart. That led to a big bull candle move on the weekly. Same thing with the purple example and the blue example that can be seen on these slides. Then we'll move over to another symbol. Same thing you're going to see over and over. All right, let's add another component, Bollinger Bands. I get this question all the time. Do you use Bollinger Bands? Yes, absolutely. Bollinger Bands are envelopes plotted at a standard deviation level above and below a simple moving average of the price. So in this example, it's going to be a 20-period moving average line, which is the little tiny dotted line that you can see on the screen right in between those purple Bollinger Bands. Because the distance of the bands is based on a standard deviation, they adjust to volatility swings in the underlying price. We may talk more about that later, but not necessarily here. That's some of the information that will be behind that join button. As we look at live examples, I'll be able to show that going forward. Bollinger Bands help determine whether prices are high or low on a relative basis, and they are used in pairs, both upper and lower bands, in conjunction with a moving average. Further, the pair of bands is not intended to be used on its own. Use the pair to confirm signals given with other indicators. So I want you to kind of throw out anything that you know about Bollinger Bands. We're going to look at them very simply, and I'm not using them for squeezes or volatility plays or anything like that. I will show you how we use them though. Really quickly, I just want to show you an example. There's a lot going on here, but let's start with the green circles with the green arrows. And we'll start with the one furthest left. What I'm simply trying to show here is that we have a StochRSI that is oversold in a strong uptrend. Let's just assume we've done all the upfront work to find this symbol. So we already know that. That shows up, and then that leads to the orange square box, okay? That orange square box on the StochRSI is just showing that the red and blue lines have both gone above the 80 level, which means it's now overbought. So this is an area we're looking at with caution. If you look at the price action just above, you can see a long tail, topping tail candle at the top, and you can see very clearly one of the biggest uses of the Bollinger Bands is that the price does not like to trade outside of those bands. You see those green candles and how they have those big wicks at the top? It's because the price did not like staying outside of those top Bollinger Bands. And then we have a red candle that forms a bit of a tweezer top. Now, my newsletter subscribers will know exactly what tweezer tops and tweezer bottoms are. If you don't, well, that's just a bonus of being a newsletter subscriber. But we move over into the next green circle and green arrow, and I drew some black arrows connecting those just to show that this happened in an uptrend. So the next green circle and green arrow is happening at a higher price level than the previous green circle and green arrow, which is important. It's very indicative of an uptrend. It's coming off the bottom Bollinger Band. The stochastic RSI has been oversold. We're in this strong uptrend, and as the red crosses blue, we move forward until the StochRSI, red and blue, are both above 80. And when we look at that price information up there as well, you can see a big topping tail green candle. I mean, these things show up like clockwork. It's really nuts how you'll see them now versus previously. Unless it's Forex. Forex, there's really no predictability with those wicks because most candles have massive wicks anyways. So but you can make a lot of money trading stocks and options looking at those candles with those wicks like that. Same exact thing on this chart, except for there's 3 examples. One of them is current, so as the time of recording this video in early February, that move is continuing upward. But starting with the left in November, you have StochRSI that is oversold. All right, it's coming off the bottom Bollinger Band. We take it up until the blue and red lines on the stochastic RSI are overbought. We have a big candle outside the top Bollinger Bands, a big red candle. That's this candle right here that we're looking at. We then move forward. We have a higher position than the previous position. StochRSI crossing higher, not necessarily off the bottom Bollinger Band, but that's not entirely important. StochRSI crosses to the upside. Now we have red and blue above 80, right around this price point, and that goes all the way up until you get a bit of a topping tail candle here. We have a bit of a tweezer right here. So there's a number of reasons to exit this trade, but we would have taken it from this level to this level, which is absolutely fantastic. And then we have another entry coming in right around here, and that has just taken off like crazy. So let's connect all the dots. I want to get into very specific trading setups for the profit market strategy, and then we're going to wrap this all up in the end. All right, so here's an example. I'm showing you the chart exactly how it would have looked on this day. So we're going to move this chart forward 1 candle at a time. So we're starting with the S&P 500. I'm just using SPY, which is an ETF of the S&P 500. And we're using this to check the general direction of the market. So one way that I like to do this the most is just look at the red line on the StochRSI. And what you can see on your screen is that red line is below 20. And I just want to point this out to you. So when the red line's below 20 here, what's the next direction? Well, the red line will leave this area and go above 80. And when it's above 80, it'll leave that area and go below 20. Above 80, it's going to come down below 20. Below 20, the red line leaves and goes above 80. Above 80, below 20. Below 20, above 80. This is what we talk about when we're saying that a fertile trading environment has good oscillation. All right, there's very good oscillation here on the general market chart. Here we are. This is the big slide that we had in September here on the S&P, and you can see we went from above 80 to below 20 before we recouped. We actually put in a bit of a divergence here, and we went to the upside. But the point is right now we're in a position where the next likely move is going to be to the upside. We're at the bottom Bollinger Band as well. So now that we know that, we can scan for stocks and filter based on net percent change. Now we're going to filter based on net percent change up because we're looking for up moves in strong uptrends. Why? Let's go back to the S&P 500 because we know the S&P is poised to go up next. We don't know when, but we know that if we trade in the up direction, it's most likely that we're going in the direction of the broad market. Remember the picture I showed you with the waterfall and the river? All right, that's right. We want to go in the same direction as the broad market index. So once we scan, we end up finding a stock. All right, so we find a stock, and that's PayPal, which is PYPL. PayPal is here. We have recently both the blue and red lines below 20 on the StochRSI. We went to make a move to 80. It never happened. We're down below 20 again. I'll show you why this move didn't happen here in just a little bit if you stay tuned. But we're also positioned to go up. I'm not going to get into all the details, but this is a good candidate to trade. And when we go into the sector, which is the financial sector, what do we find? Same thing. StochRSI is low, below 20. Bottom Bollinger Band, strong uptrend. Even though the blue line is crossed below the pink line recently, if you look at this chart, you can tell that the trend is up. So the sector is showing the potential to go up as well, even though it may not be perfect. So now we're looking for good oscillation and bull setups with volume. And what we can see is that we have a bull candle here, a bull candle here, a bull candle here, right? We have these candles that have set up in the past. And right now, this pullback on the daily chart is represented on this weekly chart by a red candle that has come down and wicked right inside this envelope. So it looks like support was found right here. So we're sitting in a spot where we have a potential, again, we're trying to catch the next bull setup, but we've had lots of bull setups, a very strong uptrend on the weekly. People and institutions have been buying PayPal really since last April, and they have driven it from a price of $80 per share or $85 per share all the way up to $250 per share, really in just like 8 months. So we check the weekly trend and daily trend. That's very simple. I'm not going to get into, this is exactly how you determine the trend. We're trying to trade stocks that are so strong in our direction that it's very easy. You just look at the chart. That price is moving up. The trend is up. It doesn't matter what lines say. You can look at the price and see that it's going up. All right. Now we want to see what I covered already, which is the daily below 20 on the StochRSI with the weekly at support. And we really like the support to be in that envelope between that 5 and 15 period moving average line. And this is how we find trading prospects. These setups have all the signs of institutional activity. So now we're going to move forward, and this is what has happened. So what we're waiting on to enter the trade is that the StochRSI crosses higher on the daily time frame. I have that circled with the green circle. We're just looking for that red line to cross the blue line. You do not have to wait on the large volume on the daily chart because it's what we're anticipating on the weekly chart. It's what we're trying to take advantage of. But if the large volume shows up like we have here, that's a good sign. Now you might look and say, okay, well, this is actually a bottoming tail candle up here. But on our entries, because of the amount of momentum we have, the bottoming tail candle does not hold near the amount of clout. Why? Because they're very strong at the end of a move. Once a move is losing momentum, they're not strong at the beginning of a move. So we're looking for a green candle close above recent red. We've already had that back here, and we prefer higher volume. So we could have entered on lower volume and it would have worked out just fine. But if we wait on the higher volume to come in, it's still a decent entry, and that's the entry I will use for this example. All right, we're going to place our stop just below the recent pivot low on the daily. So we're not using the whole candle thing that we did previously or using the candle from the larger time frame. Here what we're doing is we're just looking at the pivot low. So where the price previously moved down to before the current move started, and the pivot low was at the bottom of this candle. So again, all I'm looking for is we're trying to participate in an up move. Where did this up move start specifically? And it happened right at that very tip low right there. So I'm going to place my stop there, because if the price goes back below that stop, it means that this up move is not working. And just as a side note on stops, some of you already know this, others of you do not. I do not put in hard stops. I only use mental stops, because the last thing I want is during amateur hour for a large wick to go down and trigger my stop and stop me out of the position. I'm looking for a candle close. Remember I told you we only assess stuff at the close of a candle? It's the same thing with stops in me. If I don't have a candle close below this stop line, I'm not stopped out of the trade. When a candle closes below the stop line, if it's barely or even a lot, I'll go ahead and exit the trade once I know that that candle has closed. Or sometimes I'll fudge just a little bit and I'll exit it like 5 minutes before it closes, because I know it's not likely to change. But that's how I do it. If you want to put in physical stops, that's up to you. It's your money. Again, I'm not giving you trading advice. I'm just telling you what I do. I don't use actual stops. So then what we do is we take the daily forward one candle at a time. In this one, we just automatically have had a big, huge volume candle. And the goal is we want to check this before market close or in the evening, after your family goes to bed. Notice that I highlighted after your family goes to bed. All this trading activity should be done with your family's best interest in mind, and in my opinion, it should be done for them. Now, this is my opinion. Take it or leave it, but I'm just telling you how I feel. All of the stuff that I am teaching and explaining, I would not teach it to anyone if I knowingly knew that they were using this and paying attention to this at the cost of their family. All of this should come as a bonus to your family. It should come as something that adds value to your life and to your family. It's what I believe in very strongly. So I believe in putting the kids to bed. I even tell my wife goodnight before I come in and open my stock charts and look at them, because the last thing I want is for any of this to take away from the most precious things in my life. So again, I'll end that rant right there. But I've seen too many people become too infatuated and obsessed with this type of thing, and it usually comes at the cost of the people that they love the most. Anyways, I'll move on past that. The goal when you enter into a trade is to look for a long tail candles, tweezers outside the Bollinger Bands, candles outside the Bollinger Bands, or StochRSI being over 80. I have a whole video on tweezers, by the way, if you're curious what those are. So we don't have any reason to exit this trade, but I do want to show you that the volume is already elevated on this green candle. We accurately predicted a big bull candle on the weekly chart, which is exactly what we wanted to do. So we're going to move forward another candle, and you see that whole candle, we're looking right here, that whole candle is outside the top Bollinger Band. So if you wanted to exit in that place, I would not fault you. That's not a bad exit. But what I'm looking at is the fact that the StochRSI, even though the red line is above 80, the blue line has not caught up to that 80 mark. And I know that there's a very high probability that that blue line will eventually make it above 80. So personally, I would stay in this trade. So now we have this big candle outside of the top Bollinger Bands. That's a fantastic move. We've moved on into the next week. That candle happened on higher volume. Again, the blue line is not where we would want to see it above 80. So, but I could also make a very strong argument to exit here. This entire candle, this one too, but this entire candle is outside of a Bollinger Band. When you have an entire candle outside of a Bollinger Band, the most likely thing to happen next is for the price to come back inside those Bollinger Bands. It does not mean that the move is over, but it does mean that the price does not like it outside those Bollinger Bands, and only under extreme buying conditions will it stay out there for any period of time. So to me, this is a perfectly suitable exit, but I'm still going to stay with the same talk track of, and I'm just being honest. Even though the blue line is not met it there, that makes me so nervous during live trading that I'll almost always exit on that candle. But let's just stick with the whole idea of the blue line reaching above 80. All right, in this example, we got lucky, and there's another big candle outside the Bollinger Band, and now the blue line has caught up. It's above 80. We have a whole candle outside the top Bollinger Band on the weekly chart, which is another kind of bearish indication. I did say that accurately, bearish. In other words, the next direction is going to be down. If you wanted to stay, you could stay. I personally would probably be gone. I'm going to go ahead and call this the exit right here. Why? We have this whole candle outside the top Bollinger Band. We have a tweezer top forming. That's just a green candle followed by a red candle. Visually the same highs above the top Bollinger Band. The StochRSI is almost maxed out as far as it can go above the 80 line. We should probably exit here. But even if you didn't exit, guess what happens next? A huge topping tail candle. What do you know? I told you, these things are everywhere. So pay attention to those topping and bottoming tail candles, especially when the tail or the wick is larger than normal. And what is normal? Well, normal, just look at the size of the wicks on all these candles. Is it easy to see that this wick is a lot bigger than all the rest of the wicks? Yes, absolutely. So it's something to pay attention to. It means that something different is happening. So that candle happened on huge volume as they usually do. But all this is a big fight between buyers and sellers, and buyers drove the price up, way up, and up past $300 per share. And eventually you can see that the sellers brought it all the way back down. Notice how conveniently it ends right inside those Bollinger Bands. We are maxed out on the StochRSI, and all that trading happened on huge volume. So we had a huge volume of buyers and sellers, and the net outcome was that the sellers won, which means I am leaving this trade. I'm not sticking around to see what happens next. So let's talk about the returns. Ooh, this is the exciting part. All right, so I'm just going to draw a yellow line, a divider. And so here on PYPL, the trade that we just outlined, the entry price is $251.90. I'm going to assume we stayed until this big topping tail candle, but really, if we would have exited on any of the last 4 candles, our exit price would be very similar. But I'm going to say the exit price is at 285.03, which is the close, as you can see by the green bar on the chart. That's where this closed. So the net profit per share from where we bought to where we closed was $33.13. So that means that the percent profit is 13.15% in 6 days. So this was a trade that lasted 6 days, and we would have made 13.15%. That's not a bad trade. That's actually really good. But here is what would have happened had we done the exact same trade, the exact entry, everything identical. But instead of trading this stock, we would have bought an option. Very specifically, we would have bought the 260 calls that expired February 19th. I have very specific rules for how we buy and sell options, how we select options, how we trade options. All of that is behind that join button. But the PYPL option entry price would have been $8.50 at the same time that the stock price was $251.90. All right, we would have exited, as you can see on the chart, at $25.35. So I did that wrong. The actual exit is $25.45, which means it's an even greater return than I calculated. But I just said $25.35. So that means that the net profit, not per share, but per contract, would have been, or I should say per option, would have been $16.85. That is a profit of 198% in 6 days. That's not a typo. 198% in 6 days. Had you placed your stop at the same place that I mentioned putting the stop for PayPal on the stock, then your risk would have been about a 50% loss. So for a 50% risk, you made 198%. But here's the greatest part. The greatest part is that even if your stop didn't work out, because you're buying an option, not selling an option or doing anything fancy, but just buying the option, your risk is 100%. So the most that you can lose is 100% of what you put in that trade. So worst case scenario, you could have lost 100% in this option trade, but what actually happened was you made 198%. So that's a 2-to-1 reward to risk ratio, assuming that you lose 100% of what you put in there, which wouldn't have happened. But if you would have lost 50% at your stop, well, now we're looking at a 4-to-1 reward to risk ratio. Again, options are incredible, but I have made it a point not to even discuss options on this channel until I cover everything that I've covered in this video, because options are extremely dangerous if not done in the proper trading environment. If you just try to apply options trading to any old setup or any old type of technical analysis crossover, you can lose so much money that it's nuts. All right, let's do another one. Soup to nuts, start to finish. Let's walk through the whole process. Check the general market direction, the Dow, S&P, the NASDAQ. I mean, check all of them. But in this particular case, you can see, look at the StochRSI, the QQQ, which is the NASDAQ, is oversold. So we have been below 20. Now, I'm not paying attention to that blue line. I'm paying attention to that red line. That gives me enough information to know that the next likely direction of the general market is to the upside, which is really good because I can see it's in a strong uptrend. So then we scan for stocks and filter based on net percent change. And what I pulled out this time was the SOXL example that I've covered previously. It's just I had to pull something from my watch list from this past week that actually worked in trades that I did. And I thought it would be more accurate to use symbols that I actually did in real time. So looking at SOXL, 560.22 is where the current price is. We have a really good setup, but now we need to check the sector. The sector is the technology sector because we're looking at a semiconductor stock. And even though the technology sector is not below 20, I want you to pay attention to where the red was most recently. Most recently, the red was below 20, not above 80, below 20, which means that this is going to try to meander its way all the way up above 80, most likely. So now that we know that we have good synergy between the overall market, between our sector, and between the symbol that we've chosen, we want to look for good oscillation and bull setups with volume on the weekly. Look how strong this trend is. And so you have a big bull candle here, big bull candle here, another big bull candle. We've come down. We're testing this envelope. We have good oscillation here on the stochastic RSI. So this checks out as a very good candidate. We check the weekly trend and the daily trend. That's really obvious here. The price has been going up. Next, we want to make sure that the daily is below 20 with the weekly at support. So we're finding support right at the 5-period moving average line. This wick dipped into this envelope just briefly, and the price is now reversing on the daily, which means that this is a really good candidate for a big bull candle on the weekly chart. And if we're already in using the daily chart, then we'll be riding on the backs of these giants to a really good profit. Again, this is how we find trading prospects. These setups have all the signs of institutional activity. So, StochRSI cross higher on the daily time frame. I'm just highlighting that on this slide. We definitely have that. The green candle closed above a recent red candle open. Yes. And it's happening on higher volume. In this case, no. But again, I told you I don't need that necessarily to enter into this type of trade. Because I'm anticipating the volume to tick up really high after I'm in the trade. That's the big goal of this setup, is to be there when the volume shows up. So I'm anticipating that volume coming in after I get into the trade. So it doesn't have to be there. Next, I'm going to place a stop just below the recent pivot low. That recent pivot low is coming down here to the bottom of this red candle. You can see where the price moved, and now we started this up move. That's the recent pivot low, so I'm going to place the stop right there. Again, you can place actual stops. I don't. Take the daily forward one candle at a time, checking either just before the market close or in the evening after your family goes to bed. The goal is to look for long tail candles. And then one other example, if you're someone who doesn't have a family, obviously, I'm not talking to you about your family going to bed, but there are other priorities in your life as well. Remember that trading should always add to your lifestyle. It should always improve your life. It shouldn't detract from it. So no matter who you are, I think there's wisdom in not allowing this to completely dominate your thought process in your life. So we're going to take this trade and we're going to look for tweezers. We're going to look for long tail candles. We're going to look for candles outside the Bollinger Bands. And we're really going to look for the stochastic red and blue lines to be over 80. So we've entered this trade. And since we've entered this trade, we are at a loss. Look at this red candle. Red candle came in at higher volume. We move forward. We've got a little green candle. So far we've been in this trade for a couple of days and we are underwater. We move forward now. We're in this trade like 3 days, still nothing. But we have no indication to leave. What we're waiting on is what we get right here. We start to get the higher volume green candle. That means that we're probably in the right place. Hopefully it's at the right time. But you can see this big green candle coming in, taking out those red candles on higher volume. This is a very bullish candle. And so it kind of tells us, hey, we're in the right spot. The move hasn't fully manifested yet, but we're in the right spot. Next, we get like a doji candle. What the heck? This is trading. This is how it works. Patience will make you a fortune. Just do the work that you need to do before you hit enter. And that's really the only thing you ever can do. Once you hit enter once you hit enter and get into a trade, no matter what you're trading, it's totally out of your control. The only thing you can control is the work that you do before you enter the trade. And that's what this whole presentation has been about. So once we're in it, we're in it. So we go again. Look at this. 1, 2, 3, 4, 5, 6 candles in. That's 6 days. That's a whole market week plus another day. And we've not made any money. That's what makes trading hard. This is what will separate the people who can successfully do this from those that can't, because that's hard. That's hard to stay in that position without saying, okay, I'm going to go ahead and cut this before a big red candle shows up and wipes me out. But this candle came in on higher volume. Our stochastics are still looking good. Everything else, every other reason that we use to enter the trade is still valid. So to me, there's no reason to exit. And then, yes, all of a sudden it shows up. Now, when I put this screen capture onto this slide, this is where we were on price. Since then, it has moved higher, as we would suspect, because I don't actually have an exit. You see, we're pushing the top Bollinger Band open. See how it's opening? That means that the Bollinger Bands are making way for the price to move higher. We have a nice bullish candle with higher volume, and the stochastic RSI is nowhere close to above 80 yet. So we're going to want to stick this out to see what happens. But at the time of creating this, I just assume we exited right here. I want to make it very clear. This is not a place where we would exit, but just for the example, I decided to say, let's assume we exited right there. So how do the returns look? Well, we entered at 560.22 and we exited at 662.47. Now remember, this move was still continuing, but we cut it short for this example. Net profit per share was $102.25. So that is an 18.25% return in 8 days. So even though it took 8 days to really get this thing moving, when it moved really well. So 18.25%. Let's take a look at the options. We could have gotten the option at $66.10, and we would have exited, assuming we exited right where this candle was, at 107.47. So the net profit per option would have been $41.37, which is a 62.58% return in 8 days. As I mentioned, I'm actually recording this days after creating these slides, so I can tell you, and you can look this up for yourself, but these same February 570 calls on SOXL are now well above 100% return in a matter of 10 or 11 days. So again, really good return on the stock, really great return on the option. And we're going to talk all about that behind that join button. All right, before I leave you, I have to talk about sizing your position and a little bit of money management stuff, but we're very close to the end now. So there's two ways that I see traders get this wrong. Sizing kills traders. The trader's job is to find the right environment to trade in and then take advantage of that with proper allocation. All right, so there's two mistakes I see people make very often. Number one is static stock sizing. So this is the habit of trading the same number of shares regardless of the ticker that you're trading. When you think about this, this is similar logic to taking a 30-cent stop on every single trade you make, right? Imagine you're trading a symbol that's $500 and then you're trading a symbol that's $5 and you decide to do a 30-cent stop arbitrarily no matter what. It's totally senseless. It's the same thing for static stock sizing. Different symbols have different amounts of volatility, and therefore they must be sized differently. You can't just, you can, but it won't work out well. Don't just pick something and say, I'm going to buy this many shares no matter what. The other thing is static dollar sizing. I've had this preached to me up and down, and mathematically it does not make any sense. This is the habit of trading with the same exact amount of money on every trade regardless of the ticker. So imagine placing $1,000 into a stock trade, like on a symbol like General Electric, GE, which moves, it's not very volatile. It doesn't move a whole lot. And then imagine placing that same $1,000 into a stock like GameStop recently when Wall Street Bets was buying and selling and it was going absolutely crazy. One obviously carries way more risk than the other. So the same, even though the money may be the same, what you're putting it into is entirely different and carries with it an entirely different risk profile. So that's why you would not use static stock or static share sizing, nor would you use static dollar sizing. There's a number of ways to combat this, but this is the way that I prefer the most. Not saying it's right or it's the way you should do it. This is the way that I have found to do it. This is how I allocate shares. At the point of entry on a trade, you measure the distance between your entry and where you place the stop, Remember, we just talked about that being the recent pivot low, and we showed that in examples. So you take the distance between the entry and where you would place your stop. Now, you should already have predetermined the amount of risk that you're willing to take in a trade. So let's look at an example. This will be different for each of us depending on our risk tolerance, but let's assume that a trader does not want to risk more than $500 in a single trade. Now let's assume that we have a good trade set up in entry, just like the steps that I covered in previous slides. And let's also assume that the difference between our entry and the recent pivot low is about $24, all right, or 24 points. What we would do is we would divide our risk, in this case it's $500, by the distance between our entry and the recent pivot low. In this case it's $24. All right, so we would take 500, divide it by 24, and we would get 20.83. What I will do is I will round down. It's up to you if you want to round down or round up, but I round down to stay more conservative. So I would be buying 20 shares of that particular symbol based on the distance between the pivot low and my entry, which is determined by the momentum and volatility of that stock. So my risk, when you hash it all out and I just buy 20 shares, it's going to be right around the $500 risk amount that I wanted it to be, regardless of the symbol that I'm trading and regardless of how volatile that symbol may be. So with a volatile stock, you'll notice that you will buy less shares, and with a non-volatile stock, you'll notice that you'll buy more shares. Why? Because the distance between the pivot low and your entry they're going to be different depending on how fast that particular symbol is moving, which is also indicative of how fast it will turn against you. But the point is that we're trying to keep a constant level of risk. That's the goal. We want to focus on risk and have that be the thing that determines how we size our positions and how we trade.
All right, so here we are. We finished the course. Now I know that there's more to be covered, and that's why I'm offering to cover more. But at the same time, I didn't want to make a 10-hour video. I didn't cover shorts very specifically, and I barely touched on the topic of options. But hopefully you know significantly more at this point than you did before you started this video series. Now, if any of you are interested in the stuff that I was talking about with the brokerage firm TradeStation and how they're giving access to international clients to trade U.S. markets, I'm going to cover that in the very next part of this video. I'm just going to close out with that. I wanted to pop back up one more time just to give you a sincere thank you. I never imagined stuff that I would do would get so much attention and so much praise, and I'm very grateful for that. I hope that this has been of extreme value to you. And again, if you just appreciate me putting this content out here, share this video with someone who may want to see it. Give it to someone else. Spread it out. My goal isn't to have everyone using the exact same strategy. It's to take this information. You can use this exact strategy if you want, but add it to what you do. Apply what you do. What if at the same time that I'm saying we're looking for entries on trades, the indicators that you like to use, the setups that you like to use are also confirming a position? Well, now you have a massive amount of confluence, which increases your amount of confidence in the fact that you are about to enter a very good trade with a high probability of success. So that's really it. I just wanted to say thank you, and stay tuned if you want to learn more about TradeStation and some of the stuff that they're offering this channel. All right, see you soon. So if you click the link, the very first link in the description box below, it should take you to this page right here. Now I want to be clear, I'm not endorsing or saying that you should invest using TradeStation.com. They are a brokerage company. I'm not affiliated with them at this moment. I don't receive referral fees or anything like that. It's just that this is the platform I have used for all of the charts on all of the videos that I have posted. It is the most robust platform that I have ever experienced, just based on the fact that anything you can dream up, you can literally create a code for it to populate on your technical analysis windows. They have a product called Option Station Pro, which is an incredible options analysis tool. But they are not a free brokerage. The first thing I want to highlight is that when you go to register
you should be able to populate your country of legal residence. And so what this will do is it will allow you to open an account in whatever country you are in, and you can gain access to U.S. market data. There will be a part in the account setup process after you go through all of this where you have to select the actual market data that you want. Now, I think most delayed data is absolutely free. Some of the real-time data costs money. These rates are way lower than they used to be, but obviously they are not free like Robinhood, who has no real market data, or Webull is another free service that you could use. But the thing that you may not realize is that when you're looking at options premiums and stock premiums on products like Webull, you will see that their prices are actually slightly delayed from some of these real-time data services. So in the end, you get what you pay for, but this is very cheap. So each month you'll need the Standard & Poor's, the Russell indices, the PBOT. You won't need this one. You will need the Dow Jones, so that's 4, 6, 12. So you're looking at like $17, $18 for market data each month. They deduct that out of the money that you have in your account. I don't think you need any more data. If you want level 2 NASDAQ data, that's $11. So that would be another thing that I would say go ahead and get if you can afford to do so. But that should get you about where you need to be if you're using TradeStation, and it will give you access to not only chart US-based ETFs and stocks, but it'll give you the option to trade those too if you want. Or the other option is to just create an account to use for technical analysis and place your trades in the brokerage of your choice. To me, it doesn't matter. I'm just really trying to get people on the same page to be looking at the exact same charts that I'm looking at if you want to. Because I also have a workspace that breaks down, I have kind of the tickers and the symbols that I use and different options chains and level 2 data and different charts. And if you're on TradeStation, I can just send you the workspace, and then all of your parameters populate the exact way that I have them set up whenever I make a video or do an overview video. So none of this is necessary to be able to follow along and learn the things that I'm talking about. And at the same time, this will probably make it a bit easier. It's really up to you. It's your preference and whether you want to do that or not. Again, just stating, just for the sake of stating it, I am not recommending TradeStation as a brokerage service. I'm not saying that you have to sign up to them. It's just a matter of convenience because this is who I have used for a decade now, and I'm very familiar with navigating a lot of the buttons. I get a lot of questions from people saying, well, how do you set this up in TradingView, or I use Thinkorswim. And, regrettably, I'm not able to really help because I've never had a reason to leave TradeStation. They have incredible customer support. They have facilitated all of my trades. They've been more than willing to work with me when I started this YouTube channel, so I don't have a reason to leave TradeStation, and so I'm not familiar with the other charting platforms, so I'm not very helpful when those questions come up. However, in and around TradeStation, I can answer just about any question you can come up with, and if I can't answer it, I have the resources to get the questions answered. So again, this is just a matter of convenience. If you would like to, it's the first link in the description. You can click that, and really, that's it. I think they might have some promotionals going on. You'll see that pop up if they do, where they give you some rebates or some money back in your account. But again, I'm not affiliated with any of that side of things. Just thought I would tell you that, hey, if you're trading crypto, number one, you can get crypto data and trade that on TradeStation. You can absolutely do that. So we have... I know I saw it. So Forex data. So you can get free Forex data. You can't trade Forex, but you can plot any Forex data that you want. But you have crypto, Bitcoin, Ethereum, Bitcoin Cash, Litecoin, free real-time data. And there's some futures information on here as well, where you get the free real-time data. Anyways, that is pretty much, that's it. I think that's it. So if you want to do that, go ahead and do that. I look forward to seeing all of you on the other end of the join button if you hit the join button. If not, I'm going to continue to post content on this channel I'm going to post some options content on the main channel, and I'll continue to educate on the main channel with the more granular, detailed stuff day to day happening behind that join button. So I hope you enjoyed this course, and yeah, I'm just grateful for you being here. Talk soon.